Top 10 finance concepts. It is always useful to summarize the key principles covered in a course. They are worthy of your consideration and thought. Here they are. Number 1, present value and net present value as concepts applied to cash flows coming from stocks, bonds, mortgages, projects, and firms. The value of a firm equals the present value of its future cash flows. Capital spending proposals can be implemented when the present value of the net after-tax inflows equals or exceeds the present value of the net after-tax outflows. Number 2, financial statement analysis, including familiarity with financial ratios used to measure past performance and current status of businesses, and income statements and balance sheets. Cash is king. Profit is not cash. Retained earnings is not cash. Number 3, the concepts of risk and rate of return, what they have to do with each other and why. This would include familiarity with important risk categories such as business risk versus financial risk. Risk is directly related to rate of return as specified by the capital asset pricing model. Risk is defined as variability in rate of return. Total risk is divided into business risk and financial risk. Diversification reduces risk by eliminating most of unsystematic sources of variability of returns. Number 4, the concept of market efficiency, including when it is and when it is not reasonable to assume it. Capital markets are efficient. That is, the rates of return are matched to the risk as specified by capital asset pricing model. Number 5, the risk and return characteristics of portfolios of securities. Portfolio return is a weighted average of security returns. Portfolio risk is not a weighted average of security returns, but depends on the correlations between the time series of rates of returns. That is, rates of return are additive, while standard deviation is not additive. As the holding period increases beyond 1 year, the variability of returns diminishes. That is, rates of return converge over time. Number 6, the concept of cost of capital and how to estimate it, including, but not limited to KWAC, also including a sense of how cost of capital interacts with capital structure. Number 7, capital structure theory and dividend policy. Conservative financial structures suit firms with high business risk and vice versa. Optimal use of financial leverage increases equity value, although cost of capital may rise with increasing leverage. Sources and uses of funds should be matched. Permanent uses should be financed from permanent sources. Number 8, agency concepts, costs, and theory. Since much of finance is about managing agency relationships, such as the separation of ownership and control and corporate guidance, it is the objective of the firm to maximize shareholder value, or a more modern and thoughtful statement of the objective, to maximize the rate of return on investment. Number 9, the nature and role of financial markets. Markets, the major types of intermediaries, and the major types of transactions, such as leveraged buyouts, mergers and acquisitions, initial public offerings. Long-term historical rates of return and standard deviations of return were approximately 3.75% and 3.3% for cash equivalents 5.2% and 8% for long-term government bonds, and 11% and 20% for large company equities. The rates of return fall when the data includes 21st century performance of the markets. Bond prices are inversely related to interest rates. Long bonds are more price volatile than short bonds. Discount bonds are more price volatile than par or premium bonds. The average managed fund, active, underperforms the average unmanaged, passive or index fund. More than 90% of a portfolio's rate of return is explained by asset allocation, not security selection. Number 10, some sense of regulatory history, such as where the SEC, Fed, GAAP, NYSE, NASDAQ, etc. come from and why.